Ever found yourself scrolling through your phone, streaming your favorite show, or maybe even just paying your internet bill and thought, who exactly is behind all of this? Who are the people making the decisions, investing in the infrastructure, and ultimately shaping the technology that touches so many aspects of our daily lives? That question, that seemingly simple "who owns this," is surprisingly complex, especially when we're talking about a giant like Rogers Communications. It's not just one person sitting in a corner office with a big R on their door. It's a story of evolution, of families, of public markets, and of significant power in the Canadian landscape. Think about it. Rogers isn't just your cable company anymore. They're a massive telecommunications and media conglomerate. They provide wireless services to millions, connect homes and businesses with internet and cable, and own a vast portfolio of media outlets, including television and radio stations, and even a Major League Baseball team. That's a lot of influence, a lot of moving parts. So, peeling back the layers of ownership is like trying to understand the roots of a very large and branching tree. To truly understand who owns Rogers, we need to look at it from a few different angles. We can't just point to one name. Instead, we need to consider the historical context, the current corporate structure, and the role of various stakeholders. Let's rewind a bit. The story of Rogers really begins with one man, Edward S. Rogers Sr., a true pioneer in radio. He conducted the first successful transatlantic wireless voice transmission from Canada in 1902. This innovative spirit laid the foundation for the company we know today. In 1925, he founded Rogers Radio Broadcasting Limited, and the rest, as they say, is history. Fast forward through decades of growth and expansion, and the Rogers family has remained a central figure. But the company has also evolved significantly. It went public in 1961, meaning ownership was no longer solely in the hands of the Rogers family. This is a crucial point. When a company goes public, shares are offered to investors on the stock market. This allows the company to raise capital for growth, but it also dilutes the ownership stake of the original founders and their families. So, today, when we ask who owns Rogers, the most accurate answer isn't a single individual, but rather a diverse group of shareholders. These shareholders range from large institutional investors, think pension funds, mutual funds, and investment management firms, to individual investors who have bought shares of Rogers stock. Let's delve a little deeper into these different types of owners. Institutional investors, these are big players in the financial world. They manage large pools of money on behalf of others. When we look at the major shareholders of Rogers, you'll often see names like BlackRock, Vanguard, and various Canadian pension funds. These institutions hold significant blocks of shares, giving them considerable influence over the company's direction. Their decisions to buy or sell large quantities of stock can impact the company's share price and even its strategic decisions. They are driven by the need to generate returns for their clients, so they pay close attention to the company's performance and governance. Individual investors, these are everyday people who have bought shares in Rogers. Their individual holdings might be small compared to the institutional investors, but collectively, they represent a significant portion of the ownership. These investors might be drawn to Rogers for various reasons. Perhaps they believe in the company's long-term growth potential, or they receive dividends from their shares. Their voice is often represented through shareholder meetings and voting on key corporate decisions. The Rogers family and voting control. Now, this is where things get a bit more nuanced. While the Rogers family's direct ownership stake in terms of the total number of outstanding shares might not be the majority, they maintain significant control over the company through a dual-class share structure. This structure is common in many publicly traded companies where the founders or their families want to retain control despite going public. It involves having two classes of shares, Class A shares, which typically have limited or no voting rights, and Class B shares, often referred to as subordinate voting shares or multiple voting shares, which carry significantly more voting power per share. In the case of Rogers, the Rogers Control Trust, which represents the Rogers family, holds a significant number of these Class B voting shares. This allows them to elect a majority of the company's board of directors and exert considerable influence over key decisions, including the appointment of executives, mergers and acquisitions, and overall strategic direction. So, while the Rogers family might not own the majority of the equity in the company in terms of the total number of shares outstanding, they wield significant control through their ownership of the majority of the voting shares. This is a crucial distinction to understand when answering the question of who owns Rogers. This dual-class share structure has been a subject of much discussion and debate over the years. Proponents argue that it allows for long-term vision and stability, preventing short-term market pressures from dictating the company's strategy. They might point to the Rogers family's long history with the company and their commitment to its growth as a benefit of this structure. However, critics argue that it can lead to a lack of accountability to other shareholders. Even if a majority of non-family shareholders disagree with the company's direction, their voting power is diluted by the Class B shares held by the Rogers Control Trust. This can raise concerns about corporate governance and the potential for the interests of the controlling shareholders to outweigh those of minority shareholders. The recent boardroom battles and family disputes within the Rogers family have further highlighted the complexities and potential drawbacks of this concentrated voting control. These events have shown how internal disagreements within the controlling family can have significant repercussions for the entire company and its stakeholders. Beyond the shareholders, there are other important stakeholders who have a vested interest in Rogers' success and could be considered to have a form of ownership in a broader sense. Employees, the thousands of people who work for Rogers, are crucial to its operations. Their skills, dedication, and hard work directly contribute to the company's success. In a way, they have a stake in the company's well-being, as their livelihoods depend on it. Customers, millions of Canadians rely on Rogers for essential services like mobile communication, internet access, and media. Their loyalty and spending power directly impact the company's revenue and profitability. In a market with increasing competition, Rogers needs to cater to its customers' needs to maintain its market share. The Canadian public, as a major telecommunications and media company, Rogers plays a significant role in the Canadian economy and society. Its investments in infrastructure, its impact on the media landscape, and its role in connecting Canadians across the country mean that the broader public has a vested interest in its responsible operation. With that said, thanks for watching, and until next time.